There are so many people out there that are going to buy life insurance and they're going to get screwed and they're going to buy some sort of a universal life policy. I am going to feel sorry for you a tiny bit. Hello, and welcome back to the podcast. Thank you very much for being here. All right, Tarisa and I are back. If we're going to bring ULs into the picture, we need to talk about what's guaranteed in a UL. In a UL, you have a guaranteed. In a VUL, there are no guarantees. And in an IUL, the guarantee is typically a 0% floor. Okay. I've seen some of them that are 1.5. But let's just use a universal life, not a VUL, not an IUL, just a universal life, because there's just a lot of mixtures of those. A universal life is the best of the worst. Okay. So ULs are, I call them the worst. But they're the best. It's the best of the worst because it will have a guaranteed rate of return. Typically, that guarantee has been 4%. So fantastic. It's a market average. It's great. What's not guaranteed in a UL product across the board, IUL, UL, VUL, mix them all, whatever's got a UL chassis, what is not guaranteed is the cost of insurance. And that is renewable term insurance. And that goes up every single year. So these people that are being talked out of, because this is the noise we're seeing, especially in the real estate world. And I'm gonna pick on, we've seen IULs everywhere, and they're really just the product that's being pushed at the moment. But in the real estate world, we have a couple of talking heads that really think that they're smart and they don't know anything. And so these talking heads are saying, hey, an IUL is better than whole life. But that chassis of that UL is term insurance. That is renewing every single year. As you get older, it's renewing at a new cost because you're more likely to die. Okay? Mm-hmm. No one's getting out of your life. The longer you live, the closer you get. And they're going to charge accordingly. And so typically what happens in these UL products is that when we see the in-force illustrations, they start to go backwards after age 65 because that's when term insurance gets really expensive. Now, we don't have enough rate of return, so we're going to grab cash value to supplement the expense. And that's what Tris is talking about when we see them go to zero. Because we need to make sure that in a whole life product, that's all guaranteed, that's built into the premium. And so people will say, well, the IUL is cheaper, the UL is cheaper. It's not cheaper. The insurance companies that write universal life also write whole life. Guess what? They underwrite you the same way. They're saying, hey, Tarisa, this is your health. You can't run through an airport, so you're most likely to die at X age. Right?
I'm just going to have everyone know I am in preferred health.
And she still can't run through an airport, apparently.
Yeah.
I am not preferred health. Y'all just know this, right? By looking at me. I am not preferred health. I am going to die before Tarisa. Okay? So they are going to say, hey, Tarisa is going to likely die at 87. Based on her health today, let's just pick an arbitrary number. She's going to die at 87. Based on her family history, she's going to die at X age. So it doesn't matter if it's universal life or if it's whole life. The insurance company knows they need X dollars to pay for Tarisa to live till 87. The difference is in whole life, Tarisa's forking the bill for all of it. In UL, they're going to go to the market and hope that the market makes a rate of return to supplement the difference. So they're going to lower the premium. Now, you can say, Mary Jo, you're a moron. You don't know what you're talking about. Well, in fact, I do. So I have a client that, well, he's not even a client, just a friend, random guy on Facebook that I'm friends with, and local guy. He went to a different insurance company and they gave him 2 quotes, one whole life, one universal life, exact same death benefit. Whole life was more expensive than universal life. Why? because there's not a market return to make up the difference in the premium. Now, I've had UL policies, in-force policies run for clients. On a UL, it will say in order to make this premium or in order to make this death benefit go to age blah, 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 100 or 120, whatever, you will need to pay X amount of premium per year. Guess what? That premium is the same as the whole life premium, but they're not paying it. They're not overfunding it, is what the insurance agent would say, is, oh, you can just overfund this. No, you can't. It's not overfunding. It's funding it correctly based on what the company needs to pay that claim. And so I think when we're talking about guarantees and if we're going to open the can of universal life, we have to understand that variable life doesn't have a guarantee. It is 100% tied to the market. When the market goes up and down, so does cash value go up and down. Okay, that one is you can log online, open your account and see your cash value going up and down from month to month. With an IUL, it's reflective of the market. So all of these UL products have some sort of rate of return and are market driven to some extent. So do we want a guaranteed product of whole life? Cost of insurance is guaranteed. Everything is already built into that product. Or do we want to go with a non-guaranteed product, something such as an IUL that these talking heads are touting as, oh, this is the golden egg. For the love of Pete, you have a 0% floor, and they will say, oh, you're never going to go below zero. Well, Mr. Agent, you forgot about the fees. You forgot about the cost of insurance because on the illustration, it'll show it's a negative. So what do you mean I can't go below zero? You mean my return can't be below zero, but then you take out all my fees and my charges and my cost of insurance, and all of a sudden I'm below zero. So technically that's a lie. That's a lie.
It's good for people to know the difference so they know how to look at it. And I remember when I was first new to the industry, I kept hearing about IULs and I was like, I don't understand why people think this is better, but I need to understand for myself so that I can make sure I can educate people properly. And I remember sitting down with Clay for over 2 hours. This gentleman has over 30 years in the life insurance industry. And I asked him every single question I could think of. And I had him explain to me, and this is like a neutral party, right? It doesn't make a difference.
He's not making money off of Tarisa. If
No.
she's selling or not selling, whatever she's selling, he's not making money off of her.
Exactly. So he spent 2 hours with me and really broke down the differences of whole life compared to an IUL. And I just remember him saying at the end of this conversation very vividly, he was like, if everyone understood how these products performed over their lifetime, no one would ever buy it. And I'm like, okay. So this guy who's got no skin in the game of whether or not I sell an IUL or whole life insurance policy is taking 2 hours out of his day to explain to me the differences. And that was the takeaway for me was okay, well, coverage is a great thing. Yes. And people need to understand what they're buying. And so the whole zero floor and up to 13% or whatever the percentage is, it's sure, it could be true for the return. But if your cost of insurance is going up as you get older, you could essentially have your policy cannibalize itself because it needs to be sustained by either additional premium or the cash value that's inside your policy. And I think that's a big thing that people don't understand. And that's why it's really important that when you're looking at your contracts to understand that you need to don't just look at the first 5 years of the policy or the first 10 years of the policy. It's no, look all the way down to the age where you're likely to die and see what it looks like at that point. Because yes, we're doing this for infinite banking and for cash value, but also at the end of the day, most people want that death benefit to go to the people that they care about. And you shouldn't have to be worried about whether that is going to be paid out at that stage of life.
And you need to you're not going to make a 16% rate of return in an IUL. I mean, that's like saying I'm making a 16% rate of return in the market. Yeah, 1 year you might, the next year you might lose. And so you've got the ups and the downs, and you have to look at the average. And you have people, unfortunately, you as a consumer have to do your due diligence. And it sucks for you. And I say it all the time because you have so many people out here, and we're one of the talking heads now, right? You have so many people out here saying, oh, hey, this is better than that. And you have to look at this and you have to look at that. No, you don't. It's very simple. You have to work with a good company and a good agent, and do you want it long term? Nelson said, think like a forester. You should be thinking long term. You should be thinking generations down the road. You should not just be thinking today. And what product is going to get you there? The one that's 200 years old. IULs are not 200 years old. ULs are not 200 years old. ULs didn't start, I think the first UL was 76 maybe. IRA started in 74. And so we have this huge influx in 74. And then insurance companies came right behind with UL products because everybody was canceling whole life and chasing a rate of return. And now you talk to all those people that canceled their whole life policies, some of my family included, and then you look back and go, whoa, they were chasing a rate of return and now they're retired, worried about how much money they're going to outlive because they canceled these policies, which were super slow because they were base only. Well, they would have been better off with that, using it as income tax-free money for retirement rather than having some kind of money in the market that's taxable, that's subject to ups and downs, all the things. You have to look at that stuff. And so many people are stuck on this rate of return. They're stuck on the non-guaranteed side of the policy. They don't want to wait. They don't want to capitalize. And we've talked about this in another podcast, but you capitalize your mortgage, you capitalize your 401k, you capitalize your IRAs, you give up access to all that, and nobody asks questions about, oh, I don't get access to that 3% or that 5% or the 10% I'm putting in my 401k. But yet you ask and you think differently of a life insurance policy that can be utilized today because it's liquid. You have uninterrupted compound interest, you have control, you have guarantees, you have all the stuff. But instead, we go to these other people that are saying, oh, hey, look at this rate of return. If you have to make it sexy, or I just heard this the other day, if you have to make it sexy to sell it, you shouldn't be buying. And what is the most non-sexy thing in the world? Whole life.
Whole life insurance.
It is the hardest thing in the world for people to get their head around because there are no rates of return. There is nothing sexy about whole life. And what are we buying? We're buying the sexy IUL, the sexy VUL. We're buying all the sexy policy that doesn't have a lot of premium. That's what you're going to Walmart to buy life insurance, and you want it to last forever. We all know nothing from Walmart lasts forever, okay? You're going to go get a table from the Amish people because they're going to charge you more and it's going to be built correctly.
Built to last.
Right?
I kind of think about just like this dynamic. To me, like buying a whole life insurance policy that's structured properly with a great agent is like purchasing a fixed mortgage. Like, you know what you're getting, you know it's not going to change, and you can sleep well at night. Whereas the alternative is like, okay, you're buying a variable rate. A lot of people don't like those. Why? Because it's not locked in.
That's a great analogy.
You're transferring the risk more so onto yourself with something that you don't have much control over, which is the market. So it's like a slow and steady wins the race thing, the tortoise and the hare. It's like, it's not sexy and it works.
Yep. And it's really that simple. And it all comes back to number one. The agent needs to understand the company. The agent needs to understand the policy structure and the policies and all the stuff behind it. You need to trust the agent. We're just trying to make you smart enough to know what agent to go to and to decipher who's trying to screw you and who's not. And the commission piece of it, I'm not even going to talk about. So many people want to say, oh, they're selling this because of commission. They're selling this because of commission. We all go get a paycheck, right? I don't care if you're punching a clock. I don't care if you're a business owner, whatever. The paycheck is the paycheck. Can that be a driving factor for some people? Yes. But that is not the majority of the lies that we're hearing and the noise that we're hearing coming out of people. It is rates of return. They're always looking at the rate of return. They don't talk about the seen and the unseen. They don't talk about the control. They don't talk about liquidity. At the end of the day, you have to do your due diligence, and I apologize for all the noise. I am super fortunate. I was not in Trisa's shoes. I was super fortunate to be led down the right path of whole life right away. I didn't even know what IULs were and ULs and all that stuff because I just dove right into whole life. And then I had to educate myself on the other piece of it. And so I'm fortunate that I didn't have to go down that road, but that is not where we're at today with social media, big talking heads of people saying, hey, IULs are better. And we're fighting amongst the industry, which really sucks. And it really makes you have to go out and have a minor in life insurance.
Yes. It's like trust but verify, right? Like even when I first got my first whole life insurance policy, Mary Jo's going to laugh at me about this, that I'm sharing this with you guys, but I literally went through every single page of my contract and I highlighted the things that I didn't understand. And I asked my agent every single question that I needed in order to feel comfortable signing that contract. So I think it's common, especially in today's age, where people hear something and they just run with it because someone that is famous said it. And it's like, okay, but what happened to like credible sources and like putting your own personal stamp on something? You still need to understand what it is that you're purchasing. And if there are things that you don't understand, ask a question. And if you feel like the answer to that question is not satisfactory, then maybe you're not working with the right person that can give you the answers that you're looking for.
Yep. It is very important to not make, and this statement coming from somebody who really likes to make fast decisions, it's important to not make a fast decision. It's important if you read Nelson's book and you're like, yep, Nelson said not to use universal life. He was in the industry for 50 plus years. I'm going to believe him. Great. That would be the smart thing to do, right? Because he's in the industry forever. He was here before ULs came, all that stuff. But if you have somebody throwing those in your face and you need to be educated, hopefully this podcast helped educate you. Hopefully the prior podcasts, I have done so many podcasts on the difference between ULs and IULs, and I'm just a broken record at this point. But we have to be, because there are so many people out there that are going to buy life insurance and they're going to get screwed and they're going to buy some sort of a universal life policy. I am going to feel sorry for you a tiny bit. Okay. If you didn't do your due diligence because you didn't know, I feel sorry for you. If you so-called did your due diligence and still ended up with an IUL and then don't have life insurance at the end of your life, because somebody talked you into it, it's your money. You need to understand what you are purchasing. And having an agent say, hey, this is why you should buy it, and then never call somebody back and ask them, hey, you sold me this whole life policy, but this other agent is saying this. Can you explain why they're saying that? You just took somebody else's face value. You took my face value right away. Then you switched to a different agent and you took their face value right away. And you just went based off of rates of return. And so you need to do some due diligence. Here's another great resource is Bobby Samuelson has a consulting business. Do you know the website off the top of your head, Tarisa?
Let me see if I could look it up really quickly.
So Bobby Samuelson is an independent consultant in the life insurance world. And he tears apart products and he looks at companies and he is so unbelievably smart. And he is talking about and exposing and writing blog posts about why these UL products are not going to be the best option. And what, especially in the IUL world, what the companies are doing to get around the laws that are put on them limiting rates of return. Because they used to have huge rates of return. The government came in and said, or the laws changed, and said, you guys can't do that. So they reduced their rate of return, but then they increased a dividend or a bonus or something. And so you really need to do your due diligence on what it is and how it's working. And so Bobby has a great website. He's a great resource for that. And he did a presentation a few years ago when Tris and I were at a company meeting. And he said that he had some money and he was going to put it into bonds. And so he called his friends who are financial advisors. And they're like, yeah, you could put in this bond and that bond and all these different kinds of bonds to get X amount of rate of return. And Bobby's like, I'll just buy a whole life insurance policy. Like, they know what they're doing. They already have all the bonds. They know the mixture of bonds. They're already managing this big portfolio of bonds. So I'll just buy a life insurance policy. And then I know that I got that return and I know I'm good and safe. And so it was an interesting comment because your financial advisors are saying, hey, if you want someplace secure to put money that has zero risk, a bond is a place to go. Well, guess where the insurance company is putting your money? In a bond.
And they probably have a better track record than you do because they've been doing it hundreds of years.
Yeah.
Okay, so the website is called The Life Product Review. And I remember that talk vividly because I'm that annoying person that asks questions, even if it makes me look dumb. I'm like, whatever. What do I have to lose? So I remember after his presentation, because he was basically saying that these products aren't necessarily bad, but they're over illustrated to a point where it's not really sustainable or it's not going to happen. Like like Mary Jo mentioned, it's a high average market return that is reflective of this non-guaranteed side of the illustration. And he's like, yeah, it's just like not performing like that. And similar to what Mary Jo mentioned, I don't know if at this point it's going to be in the previous podcast to this one, but if you put the two and two together and you calculate the amount of premium that's needed to pay X amount of death benefit in both products, it's basically the same because there's no deals in the insurance company. And so I'm like, okay, that's great, Bobby. But in my head, I'm like, well, what do you buy? Like, what are you purchasing, Bobby? So I go up to him and I stand in line. All these people are asking him questions. And I was like, okay, so I get that you're saying that these products aren't terrible if they're funded properly. And I still want to know if you own one. Like, do you purchase these products or do you just purchase like traditional whole life insurance? And he's like, yeah, I just buy whole life insurance. He's like, I kind of view these products as like an El Camino. It's like a truck mixed with a car. He's like, well, if you just want a truck, buy a truck. And if you just want a car, buy a car. And I was like, okay, that's all I personally needed to know from this very smart guy that probably knows way more about life insurance than I ever will, is that this is where he's putting his money. And to me, if someone puts their own personal stamp on something, especially if they're really well researched, then that's what I'm planning on doing. It's like that vote of confidence. And so I think that's important to consider. It's like, okay, great. I know what you're saying, but what are you actually doing?
Remember too that he talked about these companies are putting some rate of return on these IULs, but they don't even have the history behind the rate of return because the IULs haven't been around long enough, and yet they're going back further than what the IUL's been around to use that rate of return. So that I found that super interesting too, that they're using some arbitrage number to get their rates of return and be able to sell the product. If any of you are out there wondering the same question I am, is how in the hell are these state insurance commissioners and departments allowing this? I would also like to know that very same thing. How is an insurance department allowing a product to be sold as permanent insurance that's not permanent? I think that there needs to be some change in the insurance world because everybody talks about it like it's permanent, like it's going to be there when you die. And the vast majority of them will not, which is why insurance companies have been sued. If you look, there's lots of insurance companies that have been sued, and these IULs, there's a lot of people that have been on the list to be sued about, hey, you said we were going to have insurance. We didn't. You said the premium was never going to go up. It did. And so you've got this bad taste in your mouth, and that bleeds over to whole life. I have not yet seen an article of some whole life agent being sued because the policy didn't perform or there wasn't death benefit there. There might be an agent being sued because they're slimy and they're telling people to cancel a policy. That is a good policy, but I've not seen an article saying, hey, this death benefit never paid out and I outlived it. It's pretty hard to do when you have the right company, the right agent, the right type of policy. So with that, anything else to add?
I don't think so. This was fun. Hopefully it was helpful to everyone listening, because basically you just got what I received from Clay all those years ago.
Yeah, there's a lot of information here. I think my biggest takeaway is that I'm pretty passionate and animated, and Tris is extremely calm. And so we'll see when she comes to visit me how she likes my driving.
I'm already scared.
I'm not a fast driver.
Really? Okay.
I actually go the speed limit. However, if you're in front of me, you better be going the speed limit. If you're turning a corner, like there's a gas pedal, we don't need to go 3 miles an hour. If it's a 45, you should go 45 or 50. If it's a 55, you should be going 60, not 45. So I have low patience for slow people.
That's fair. I am a legal speeder.
Yeah.
Okay. That's good. Maybe I should get another policy before I go out there, just in case.
It'll be a fun trip.
Yeah.
She's going to find out what gravel is. She's going to see grass.
Green? A real true green?
Yeah. It's going to be big days. Well, we'll record it for y'all so we can get her reaction as she's like, I have been with Tarisa before when we were in Indianapolis, and she's like, oh my gosh, there's green everywhere. It's so pretty. And it took a minute for that to register for me why it's so amazing. But I have had other people here from Arizona, and they're like, this is crazy. You have green boulevards. Like between the sidewalk and the street, it's green. And again, it took me a minute to figure out that's called a boulevard, and we plant grass there. I'm not sure why that is so amazing. And then I'm like, oh, because they don't have green.
Because we have green turf. And that's
the bonus, you don't have to mow it.
Yeah, that is true. I love real grass, though. I feel like, I don't know, if the majority of my family wasn't in Arizona, I'd probably be somewhere else. But because everyone's here, it's just like one of those things, why move? I need some babysitters, people. I need some people that can allow me to have a fraction of my sanity sometimes. So I got to be a little closer to family. I don't know how people have kids with no family around. I couldn't do it personally. I'm like, sometimes Lily's like, are you in your room because you need some alone time? And I was like, yes.
Another place we differ, but I am Gen X and you are a millennial. And so we did not ask for help from our parents. Once in a while we asked, but it was pretty rare. I did it mostly without, and I did it while Scott was working nights. So I was sort of a single mom.
Which
we
is
saw
crazy.
him about an hour a day. And so that was that much help.
As soon as Daniel comes home, I'm like, here, take all of your children.
Have them all. I'm going to my room.
Yeah. I'm going to need some decompressing time to be a nice person.
All right, guys. Well, let us know if you have comments, questions, concerns. If you need to make an appointment, get the book. In the book is the appointment link. Set up your appointment with either one of us, and then we'll get you started. And happy to answer any questions that you have on this. Obviously, you're going to want to shop agents. Like I would definitely be shopping agents if I were you. But to shop the guaranteed side of the policy, again, like that's a little bit crazy. If the agent you're working with understands and has looked at vital signs at companies and all that kind of stuff, you should be able to trust them. 99.99999. I would probably say 100% of these mutual companies are good companies. So, okay, let us know if you need us. Otherwise, you have a fantastic rest of your day.